I'd like to welcome everybody to the CFA Society's program luncheon featuring Justin Anderson from Salman Partners. My name is Matthew Andrade. I am one of the two co-chairs for the Calgary CFA Society. We'd like to acknowledge the exclusive program sponsor of the Calgary CFA Society, the TSX and TSX Venture Exchange, and we'd like to thank them for their support, and Monica Rovers, who's here today as well, for her tireless support of the Society, both locally and with her colleagues in Toronto, who have assured me that Calgary is a little more than a spot on the Google map. A little bit about Justin. Justin completed a BSc in Mechanical Engineering and a BS in Russian Studies at the University of Calgary. He then completed a MS in Aeronautical Engineering at MIT with his research and thesis focused on energy economics, clearly a lightweight. While at MIT, Justin founded and commercialized a high-tech company called Weiby and was an executive chair of the MIT Energy Club. After completing his degree at MIT, Justin joined McKinsey & Company, where he worked on energy company strategy and evaluations. He then went to work for the investment banking energy group at BMO Capital Markets, and after founding the research company XEdge, a company specializing in rigorous stochastic or Monte-Carlo analysis of oil and gas portfolios, Justin joined Salman Partners, where he's been since December 2011. Since joining Salman Partners, Justin has initiated coverage on 19 Canadian-listed E&P companies operating in Latin America and Africa. Justin's use of the Monte-Carlo approach for the valuation of the exploration portfolios has been applauded by energy companies and institutional investors, with early indications suggesting the approach leads to significant alpha generation. So without further delay, Justin.
It's a little bit tight in here, guys, so nobody yell fire, please. Don't want to have an incident. I wanted to thank Jade and Matthew and the CFA Society for hosting this event, and I'm very grateful for everybody's interest in the audience today and for coming out and hearing me out and what I have to offer on exploration valuation. In the description that you may have read for this event, you'll see that I'm taking aim at the idea that explorations sometimes are portrayed as having sort of a free option value in the oil and gas industry, and you'll hear this comment a lot on the street, where guys would say, you know, you pay for the core production, and then the exploration's a free option. And it reminds me, that idea reminds me of a story that when I was at a conference in South Africa, there was a CEO who got up and addressed the group and said, you know, we're undergoing risky exploration in Namibia, offshore Namibia. And he said, we're jumping out of the airplane without a parachute, is how he referred to it, which you know, was surprising to me for someone of the CEO to say that. But I think the important implication of that comment is, you know, exploration is not an option. It has a significant downside risk component. When you're drilling $100 million wells offshore Namibia, you know, that's not downside constrained option territory. That is a significant downside potential. And conversely, you know, you look at a company like Africa Oil, which is a $1.5 billion company. If you go out and try to buy some shares of Africa Oil, I think you'll pretty quickly figure out that, you know, it's not free. You're paying a price for that exploration. So, you know, I hope that you're persuaded, I certainly am, that exploration portfolios are neither free nor are they an option. They have a value. And I think one of the reasons that people often sort of dodge that question of their actual value is the complexity involved and the difficulty in their valuation. So I'm hoping to present a methodology that tries to get at that problem and solve it. This work sort of began, the inspiration behind it began when I was at BMO. I was asked to do a due diligence on Condor Petroleum, a company that was IPOing based in Kazakhstan. They were all exploration. And as part of that due diligence process, I was told the proper way to do it is you take unrisked prospective resources and you do a few ratios and do a few numbers, and away you go. And you've done your due diligence. And I found it deeply unsatisfying, and I felt that you know, if we wanted to do it properly, we needed to get into distributions and we needed to properly, you know, model this. And so I was always wanting to do that. And when I did leave BMO, I had a chance to take some time and to try to build out this system. That's what I did at XEdge. And I used some stuff I learned when I was, I'd done some work for Talisman back at McKinsey, some work that I did at MIT. And I started to build sort of a systematic way to efficiently run Monte Carlos on exploration portfolios of E&P companies. And I wanted to prove the market, and part of this work is to prove, to say, it can be done efficiently. We've launched coverage on 19 companies within a year, and using this methodology. So I think that proves that it is a system that with a lot of hard work you can actually roll it out. So let's get into it. I'm going to jump really quickly through these first pages. Standard approaches to valuation in oil and gas companies. This is a CFA crowd. I guess before jumping too much into this, who here has seen the SPE presentations that I gave? Just to get an idea of the audience. Just a couple. Okay, great. So we'll spend some time talking about the theory behind it, and then we'll get into some of the results, the performance results of how our stock picks are looking. So this first page is discussing kind of the basic valuation methodologies out there today. Don't worry that if you can't really see the numbers, they're not really that important. The basic premise is you build trading multiples or transaction multiples, you compare them to the company, and you kind of figure out what you think it's worth. You can do the same thing in a little more detail using a DCF model. That's where you're actually doing kind of an absolute valuation. This is all finance 101 type stuff. So how is Monte-Carlo different? Well, first of all, what is a Monte-Carlo simulation? Most of you have probably heard that term. I'm sure a lot of you know what it is. For those who don't, it's not complicated. It's very simple. All you're doing is you're taking, and you can do this for any model effectively, you're taking some of the inputs into your model. So on the top side here, you're looking at a model. You have inputs, you have the model engine, and then you have outputs, and it's all deterministic. So you put one number in the input, and you get one number out on the output. For a Monte-Carlo model, you're taking some of those input variables. It's the same idea, same structure, and you're simply defining them with distributions. This is very commonly done in industry to define resource distributions in their prospect portfolios. So companies, third-party engineering companies, are often commissioned. They'll look at the different geological factors that are defined in a particular prospect. Each of them won't be defined by a single number. They'll be defined by a range as the engineers analyze and interpret the geology. And then they'll run it in a Monte-Carlo, and their output will become a P90, P50, P10. That's for a given prospect, and a chance of geological success, which is known as the P sub G. And it's those variables, that field size distribution and the P sub G, which are the variables. When I talk about Monte-Carlo and exploration, those are the two variables that I'm defining as probabilistic. The rest are not. The rest of the variables are deterministic. This is more for your reference. I'm going to make this presentation available for everybody, so don't read through it. Just if you pick up this presentation and you want to kind of contrast the different methodologies, here's a page that does that. So want to spend some time on this one. Take a step back for a minute before you digest this too much. Actually, I'm going to use the B key, which is a very nice key. Oh, it doesn't work. Never mind. Oh, I guess oh, it doesn't matter. You can normally hit the B and it hides the presentation, but I'll just suggest that you try not to digest too much on there and just put your attention towards me for a minute. So if you think start by thinking about uncertainty in exploration or in anything for that matter, and try to think that there are different kinds of uncertainties out there. If I hold my hands out like this, and in one hand I have a dice that has a number between, an integer between 1 and 6, and in my other hand I have a random number, it could be anything. They're both uncertain. You don't know what number I have in either hand, but there's a lot you can say about this one. You can talk about the probabilities of different outcomes. And in terms of this graph, shifting your eyes to here, the difference between these two kinds of uncertainties is they're both exposed to the x-axis uncertainty, which is the actual outcome uncertainty. You don't know what the outcome in either case is, so you're far to the left of the graph, meaning you don't have a lot of outcome certainty. However, there's a big difference in their y-axis attribute, the possible outcome certainty. So in this case, you know the possible outcomes, you can define them, in this case, perfectly, whereas in this case, you can't. So the left hand is in the bottom left, sort of undefinable understanding of the outcomes, whereas the dice is in the top left, where the outcome is uncertain, but it's well defined. So bringing this to the oil and gas world, how does it apply? So the oil and gas world, we begin. Here's a picture of Spindletop there for you. You're drilling a well out in the middle of nowhere back in that time, and they had no clue what they were looking for and how much it would be there. There was no way to define the output. So that is something that is in the bottom left. No Monte-Carlo model, nothing is going to tell you, a priori what Spindletop is worth, and whether they should have, have drilled that. Of course, in hindsight, they should have. Now, as you're running your seismic, you get analog well data, you start to improve your geological interpretation and your model, you start to move up the y-axis. So you still don't know for a given prospect what the outcome is going to be when you drill the prospect, but you're starting to say, okay, well, I can start to define this prospect, and you move your leads into prospects and your prospects into drill-ready prospects. And then only when you're happy with your analysis of the risk and the distribution, then do you drill. And you still, at that point, don't know what the outcome is going to be. There's always uncertainty on any well, but you've now characterized it. And so you're in this top left world. And my argument is that's where the Monte-Carlo needs to be applied. If you apply it in the bottom left, you're doing garbage in, garbage out. If you apply risk nav, which we'll get into, to the top left, you're doing the incorrect analysis. You're missing the tail risk. And there's an example in the real world of, here's a blackjack game. It's a perfect example of a top left game where on any given hand, you don't know what you're going to get, but you do know the probabilities of different combinations. So it turns out if you study blackjack and you want to figure out optimal card play for a given combination, if the house has 20, what should you do under different cards? The only way to get that table created is with a Monte-Carlo simulation. You cannot create it with a deterministic model. It's impossible. I encourage you to look it up. And likewise, like blackjack, oil and gas assets that are in that top left, well-defined, but still fundamentally stochastic or probabilistic, require Monte-Carlo analysis to properly value. And that's the argument I'm making today. As you drill your wells and you discover your fields and you begin to produce them, you move into the top right corner. You're starting to massively de-risk how much resource is there. You're moving from volumetrics to decline to mass balance analysis in terms of your geology. And the value of probabilistic analysis starts to be diminishing. And so using a DCF or multiples is fine, and there's no argument there. So here is a setup of kind of taking this graph and saying, okay, here's how you should do it. How is it being done on the street today? So producing assets at the top, we're using multiples, deterministic DCF. So if you remember, producing assets are the ones in the top right. So we're using deterministic and multiples. No problem there, check mark. Exploration assets, what's being used? This is sort of best practice. Worst practice is multiples, which is just downright scary. But best practice on the street is something called risked NAV. And what that is, it amounts to, there's an example at the bottom, you're taking working interest, multiplying that by the middle of the distribution, multiplying that by the chance of success, you get to risked recoverable resources. Plug that into your black box model, and out pops a value, add them all up, and you have your valuation. I appreciate the laughter from Dave. This is a geologist laughing, by the way.
We've never done that. I swear.
So, and obviously the criticism is that you're applying a top right tool to something that is fundamentally in the top left. So why is that a problem? So here's some numbers that indicate why it's a problem. This is theoretical, and we'll try to go a little more practical on the next page. But from a theoretical framework, if you think about 4 different games and the risk profiles of these games, they each, game 1 is you get $1 million. It's a good game. I mean, I want to play game 1. Game 2 is 50-50, you get $2 million or nothing. So you're adding risk. Now the expected value is the same. The risked NAV is the same. Okay, it's going to give you 1 million. You're going to take 2 million and you're going to risk it by 50%. Game 3, 1% chance you get 100 million, or most of the time 99% you get nothing. So now you're taking one big step in increasing that downside tail in your outcome distribution. Okay, so you can intuitively you can say, well, I want game 1. It's a lot less risky. But the reason behind that intuition is because you don't want exposure to all that downside in the tail. But if you use a risk NAV approach, it's coming up with the same valuation, a misvaluation. And so the question then becomes, well, what is the valuation for these different games? And the number on the far right are just illustrative. They're not actually based on any math or any analysis. It's just to show you that as the risk of the downside tail is increasing, the valuation of the portfolio is decreasing. And the factors that are really driving that, again, intuitively, is how much is in that downside tail. So you have your average here. How much downside am I taking on? And what is the price of downside, or what is the price of risk, put another way. And that the price of risk, if you remember from your CFA studies, there's the risk return graph. And what's the slope of that graph for all you CFAs out there? Take notes. These guys haven't been keeping up on their studies. It's the Sharpe ratio, okay? So that's the slope of that graph, and it gives you an idea of how much risk costs. So take the Sharpe ratio, take the downside in the curve, which is the semi-deviation if you're dealing with non-normal curves, because you don't want to punish people for upside. And you have your two ingredients for trying to calculate how much you should adjust the value by. There's a whole derivation behind the risk deduction, how much you need to reduce it by, and I encourage you to look at some of the work that we've put out on that if you're interested. So here's one step towards oil and gas world. Same kind of idea. We're going through an example of a risky situation, trying to value it, but now we're trying to kind of represent a more realistic oil and gas world situation. So imagine a game, you have a bunch of bills in the game, you flip a coin, if you get heads, you get to reach inside, you get to randomly pull out a number and keep it. If you get tails, you get nothing. You pay X to play the game. What's the game worth? How much should you be paying to play? Okay, this is the fundamental question before us that we're trying to solve for, is what is the value of the exploration portfolio? And we're trying to mimic a kind of an idealized version of exploration. You're drilling a well, you have a binary outcome, that's the coin, and if you're successful, you have a distribution. So you might find a lot of oil, you might find a little bit of oil. Okay, so it's very analogous. Now, if you use risk NAV, you start with 1,000 as the unrisked mean. Okay, that's the average. I've given you a distribution here. That's the average in the box. And you risk it using the risk NAV procedure at 50%. You come up with $500. Now, if you can only play this game once and there's risk, is it really worth the expected value? Of course, the answer is no. So then you run the Monte-Carlo. You get a curve of outputs. You can visualize the curve. You get a big spike at 0 at that whenever you get tails. And then you have a normal distribution around 1,000 as the success case. And so that's the curve, and then the question is, how much should you pay to play that curve? And using the principles that I discussed back here, Sharpe ratio, semi-deviation, and that derivation, you can come up with a downside risk adjustment factor. So as you increase the standard deviation and therefore the risk, that adjustment increases, and so you're bringing down the value of the game. Okay, so that's the theory behind putting a single number on a curve of exploration outcomes. So how does this work in practice for our reports? As I said, we've initiated on 12 companies, or 19 companies. This is what we've done on those reports. We start by looking at the company. We classify all of its assets into leads, prospects, and drill-ready prospects. And we try to focus our analysis for the Monte-Carlo onto the more mature prospects, the stuff that is better defined. And it's very important that you steer clear of trying to do leads and those kinds of assets that are still ill-defined. Because you will get into the garbage in, garbage out. You'll create fancy graphs, and unfortunately, there's no way to solve that problem. No one is ever going to be able to value an undefined oil and gas asset. It's just not going to happen. The data just isn't there, and anybody who does that is just trying to sell something. So as you move up into prospects and drill-ready prospects, you run your stochastic DCF, you run your Monte-Carlo, you get your curve, and then for the assets that are well defined, that have been discovered, basically usually the reserves and the production, you use a deterministic DCF, or we use a deterministic DCF to model it. So here's how it all kind of comes together. This is a company that actually, relative to its base portfolio, doesn't have a lot of exploration. It does have a lot of exploration, but relative to their core assets. So this is Pacific Rubialis. We have a $25 hold target on this company. You can see in bucket number 1, that's the company base. So that's using the DCF, deterministic DCF model to go asset by asset. You can see it here, with all the different fields that the company's booked basically reserves, and most of which they have production from. We're running a DCF model on each of those assets and coming up with a valuation, adding them all up and then adjusting for G&A, net debt, basically if they have cash on the balance sheet, tax effects, and then come up with a company base. To that number, we add the exploration valuation, which is number 2. We run a Monte-Carlo simulation on the drill-ready and mature prospect portfolio, come up with a curve that looks something like you see on the top right, apply that approach to adjusting for the risk. In this case, it's a very well-diversified portfolio. They have a lot of exploration, and so you really start to see the power of diversification in the portfolio, because it gives you that more bell curve and pulls you away from that extreme log normal curve that you'll see in a lot of the small caps and micro caps when they're doing high risk exploration. They have this huge spike on the fail case and then a long tail if they're successful. So you can see the power of diversification. And then 3 and 4, 3 we just do a qualitative adjustment. We pull it out so that, for example, if Pacific Rubialis, they're doing the STAR program, they're well positioned if Venezuela was ever to open up. So these are kind of factors that you can't really value quantitatively, but we wanted to give them some value for it. So we gave them, I think, 10% of or 5% of company base value there. But more importantly, we pull it out so guys looking at this can say, okay, well, that's the number from the core, and here's the number that they're kind of giving them on qualitative. And then finally, there's dilution, which is, if the stock reaches the target, you're going to have some options being converted, which is going to dilute the shares a bit. So that's sort of the analysis, and we kind of systematically do this on all the companies that we cover. Now, this part of the presentation is new. What you've seen to this point has already been presented several times both to the SPE and also to several companies. And what you're seeing now has never been presented before, so it's brand new stuff. One of the first questions I would get when presenting this material was, well, this all looks really good in theory, but does it work? Can you actually increase your resolution and understanding of expiration, and can you achieve better returns from that? That's the natural next question for anybody running a fund. And so this work began trying to answer that question in a very methodical, systematic way. And it starts off with the premise that in order to do this, we have to build a methodology that is unbiased and that is repeatable, so that anybody in this room can sit on a Bloomberg terminal, punch in the same methodology, and get the same result. So it's not, we're not just cherry picking kind of successful calls and that sort of thing. And so what we did was we began by looking at different measures that are out there today. You're probably familiar with two of them, Starmine and Bretton Woods. These are two measures that guys are using to sort of rate analysts' stock picking and calls and that sort of thing. Bretton Woods is a very subjective measure. It's an interview or a kind of a request from the buy side guys to rate analysts. So it's very subjective, very difficult to do that in this approach. So we look more at the Starmine methodology, which does have one indicator, which is they call industry stock picking. And we basically wanted to use that methodology, and there's one little adjustment that we made, and I'll talk about that and why we made it. But other than that, we essentially are following that methodology to judge the performance. The basic principles behind the methodology that we chose, is A, avoid cherry picking. You got to cover everything. You look at every recommendation the analyst has made. Two is use relative measures. I mean, this is a no-brainer if you're looking at stock picking. The venture, don't cry when you look at the index there, but down 41% since we initiated using this Monte-Carlo method. And if you're looking at any good measure of stock picking is going to have some kind of index that you're trying to beat with your buys and underperform with your sells. And it turns out that Starmine uses something called an energy index, which is across the entire upstream industry, and it's a cap-weighted index. So what does that mean? That means that you're really testing your performance on your calls relative to Suncor and a few other of the big names. So my problem with that is, and I verified this, is, well, you're going to have clumping. In 1 year, you're going to have all the domestic analysts are going to be at the top because they're all going to be the top performers. And then another year, you can have international analysts all at the top because the international space was up relative to Suncor. So I found it was a good start, but I think that it wasn't providing that unbiased system that I wanted to introduce. So I was thinking, what is the ultimate unbiased index? And it's actually the analyst's own coverage. So their own stocks that they cover, that's the true unbiased index. And then how do their buys perform relative to that index, and how do their sells perform relative to that index? So are they able to take a collection of stocks, analyze them, and give you good recommendations on a relative basis of which of those are going to perform well and which are not going to perform well? So that leads to this. In the interest of time, I'm going to skip number one. There's basically two scores that we're giving every analyst. In the top right, you see Analyst Score. It's more of an academics kind of score. Number two is the mock portfolio return. This is the one that basically mimics the Starmine methodology, other than the index change that I just referenced to. So the index that we're using for mock portfolio return, again, is the analyst's own coverage, and that's very important. We call that the all coverage portfolio. Okay, so when I say all coverage portfolio, I'm referring to an index that is made up, an equal weighted index that is made up of the stocks of the analyst's coverage. So in this case, you can see the coverage in the bottom left. I don't know how well you can see that, but the all coverage portfolio would be an equal weighted index of GTE, PRE, PMD, PDQ, SNN, PXT, RPT, and VRZ, because those are the stocks that this analyst, in this case me, had under coverage at that date. So that's the all coverage. And you're basically trying to beat that portfolio, that index, with your buys, and you're trying to underperform it with your sells. So you're getting the relative bets right. So the way we construct the mock portfolio, again following essentially the star mine approach, is you start with, for your top picks, the ones that you really like, you take 3 long positions in them, 3 units of long. And what we mean by a unit, if you have 10 units, 1 unit is 10% of the value of the portfolio. So a unit is like an equal value component of the portfolio. So for GTE, you go long 3 units and you go short the all coverage portfolio 3 units. You offset that position. Okay, for PRE, PMD, you go long 2 units on PRE and PMD, and you're on the all coverage portfolio, you go short 4 units. That's 2 units each short. For the spec buys, it's 1 share each. You can't really see that because it's light blue. So you're going, or sorry, 1 unit each, and you're short 1 unit each, the all coverage. For the 2 holds, you don't take a position either way, and then for the sell, you're long the all coverage portfolio and you're short the stock. 2 units in each case. So that's how you compile your sort of, call it mock hedge fund. And then what you do is you buy and hold. You don't want to get kind of the rebalance effect, which tends to grow portfolios in a hurry with variability. You buy and hold, and you only rebalance when there's a recommendation change. Okay, so that's the key methodology. And again, I won't go over Analyst Score because for 2 reasons. One is it's just more complexity. You can read it yourselves when you look at the presentation. And 2, it correlates almost perfectly with mock portfolio return in terms of the numbers. The idea behind it is to try to be a little more time neutral. Mock portfolio return, if you're very successful early on, you tend to do a little bit better in the back end. So early performance is rewarded a little bit more, whereas Analyst Score tries to kind of neutralize that effect. But we found, I mean, it's such a short time, it's 1 year. So, you don't really have too much of that effect happening. Okay, so to be clear, what we did is we had a methodology, we had a start date, April 2nd, when we first published, and now we want to run this on every international, upstream international oil and gas analyst out there. So we basically created these graphs for every single analyst, and you can create the same graphs, again, using the methodology, plugging it all into the Bloomberg, and you should get the same numbers to corroborate it. This is an example of an average score. It's actually kind of not a great score. You can see the spec buy portfolio, which is the light blue, is significantly down. The holds in this guy's portfolios are kind of up, and then the buys are sort of in the middle. So that yields sort of a neutral result. He's getting no return in his mock portfolio return, and he's getting 0 basically for a score. Example of a pretty good score, you have a good call on the sell early on, a big drop there on one of his coverage. You can see the green line, which is his top picks, are significantly outperforming. So that's very positive. And the dotted line, by the way, is the return on, or is the performance of the mock portfolio. So that kind of hedge fund, how that performs over time using that strategy. So you can see that the sell was significantly down. That little blue jumped up, and so that's why the dotted line is kind of jumping up, because he made a successful call there, and the short position just made a lot of money in the sell there. He would have got a lot better score, but his buys are actually under the black. The black is the all coverage portfolio, but his blue is underneath the black, so there's a negative impact there. But the spec buys and the top pick and the sells more than compensate that, so he gets a positive return, 15% over that period, and a plus 10 for his analyst score. So this is what you don't want to do. Bad score, this is where you're getting your relative picks wrong. This gentleman had sells and his holds as his best performers, and his buys and his spec buys as his worst performers. Not a good idea, not adding a lot of value, at least for that period. So that's that. And then, drum roll please, for Monte-Carlo stuff. So this is how we've done so far over the first year. And I'll just give you some flavor behind this so you can kind of understand the role that Monte-Carlo played in some of these picks and how it impacted the value. So you'll see the hold portfolio, which is purple. It's actually a very important portfolio early on because we had 3 stocks in it. And part of that performance is we ran the Monte-Carlo on a company called Veraz Petroleum, if you remember that. And what that told us was, if you looked at the distribution in the curve and the downside and you ran the analysis, using a risked NAV, which is just taking the middle of the curve and risking that by some number, call it 5%, and then putting that into the black box, it was actually pushing the valuation up significantly higher than when the Monte-Carlo showed that there was a huge downside component to this. And if you do the valuation, it came in a lot more conservative. And so we came out with a hold on Veraz, and that, the company drilled the one well in Peru. It wasn't successful, and so it came off really hard. But again, that insight, our price relative to the street, we were about a third of the average, street recommendation. Another company, our Patrol, we had a hold and a sell on kind of during that early period. And again, it was another example of we ran the Monte-Carlo and we kind of found from that analysis that there was actually no real value in the exploration portfolio. We ran this on a bunch of companies, and that really what drove that. If you see the blue little line at June kind of jumps up, that was Petro Magdalena when it was bought out by Pacific Rubiales. We had a buy on it, and it spiked because of the buyout price there. So that was that. And then you see later on, in September, late September, there's a big spike. There's actually three things going on there. One is there's an RPT sell, which is just one stock, so it's actually not driving. It's driving about a third of that up, but it's helping because of the magnitude of the drop. And then you have Grand Tierra at that time, which was our top pick, performed very well during that period. And we also had switched by that time to Parex Resources on a buy. We had a hold previously. And it started to perform well as they opened up the Cacheta at Las Maracas, and they were moving up in terms of their valuation. So we saw that big spike. And then over the period there where you see late into December, the dotted line starts to go up significantly. That's Grand Tierra. They made that big discovery in Peru. And again, Monte-Carlo showed us the power of Grand Tierra's exploration portfolio, which actually had for such a big producing company was a lot of value, through the Monte-Carlo. Well diversified, and so that really caused us that drives our recommendation on Grand Tierra, and Grand Tierra helped push that up. So what we naturally did is we ran this on, we identified 24 analysts that were considered international Canadian dealer-based sort of upstream analysts, and so we wanted to cover every single person so that we didn't miss anybody. We have a much better graph than this. Unfortunately, this is the watered down one that I could get approved from our compliance. People are very sensitive when you start lining up analysts, even if you hide the names. It's a very politically hot potato subject. So, and if you are interested, I'm happy to talk to you verbally about that, but I'm not writing anything down. I do have a family. But the takeaway here is, you'll see on the left-hand side the analyst score. The high watermark was the Monte-Carlo score of 38. The low was minus 32, I think it was. And so that line there shows you the whole range of the 24 analysts. The box gives you an idea of one standard deviation both ways from the average. So you can kind of get a sense of where most of the analysts were kind of falling in. And then on the portfolio return, same idea. Again, they're correlated, and essentially you line up, analysts kind of land in the same place. So the purpose of this, and what I was trying to persuade our compliance department of, was, we're not trying to say anything about, Justin Anderson is the best analyst on the street or anything like that. This is not the message that we're trying to communicate. What we're trying to communicate is we've done this for 1 year. We've been doing a new methodology, and it's yielding extremely compelling results. It's theoretically sound, makes sense, and if you do it right and you do the work, this is the kind of result that you can achieve. So we're saying that take our research seriously. We would hope that people would consider it and use it in their recommendations. And if you can go short, all the better. Because then you can protect yourself, especially in this market. So that's all I have, and I guess we'll open it up for questions. Yeah.
How do you cut off what you include that you value for your prospect portfolio versus what you cut off? It's in terms of what stage of delivery.
Yeah.
Is it on the books to be drilled? Is capital available to drill it in a period of time?
Yeah.
How do you go about that?
Yeah, it's a few constraints. It's an analyst judgment, and the calls are basically, do they have the money to drill it? That's a big one. So if I'm looking at Veraz Petroleum, they had a bunch of blocks. They had some in the south, but they really only had money for the one well. So it was kind of all or nothing there, and so I wouldn't give them credit for those ones in the south. So that's number one constraint. Number two constraint is the maturity of the prospect. So if there's not really any good data, I mean, a good example is offshore Namibia, where there's it's in the fine line between you're starting to get better definition, but the definition of those prospects is not great. And that's expressed by, some engineers put the chance of success at 5%, others put it at 20%. I have no idea where they get 20%. But, so I think those are the two key factors to answer your question is, do they have the money to drill it? And how well defined is it? Now, there's also kind of a third, call it practical consideration, which is, do we have the information? Does management actually give us their whole prospect portfolio? Can we actually get access to stuff that's 3 years down the road, 4 years down the road, and actually come up with a reasonable projection? So we will, if the data is there and we're looking at a PRE that's got plenty of money and they're going to drill that at some point, we'll be a lot more liberal on what we add in terms of versus a small cap company that might be a little more uncertain in terms of the funding. Yeah.
I guess just the difference between this approach and the the standard risk nav approach is basically under a risk nav approach you're missing out the risk aversion differential.
Right, yeah, you're missing,
and that's the major value add to this approach.
Absolutely. The argument is that the resolution is increasing significantly in terms of the true value. Right now, the risk nav is kind of a bird's eye view. It's almost like a multiple. You're getting a rough idea. And what we're saying is zoom in, these are the goggles, put them on. They'll give you a lot better view of, the true value of the portfolio. And to get that, you can't just get the average return. You need the risk. And the risk is in the tail.
Right. So if people applied the correct risk premium, they'd get the exact same answer. It's just the question is, how do you define that risk? And this is a way to define it.
Well, exactly. So the way they adjust the premium is they say we're going to give it a 10% risk factor, right? So rather, the only way you're actually going to get the risk, like you can fluke out and happen to put the right number and land on the same number, absolutely. But that's you're not systematically going to get that. The only way you're going to systematically get the right tail is if you actually model reality, or as best as you can model reality, which is how the wells will be drilled, and a Monte-Carlo simulation is the way to reflect the reality and to capture the true range of outcomes that the portfolio will have.
Okay.
Yeah.
How do you develop all those distribution curves for various parameters or inputs?
So we prefer to take third-party engineering reports. A lot of guys are doing these kind of prospective resources reports, and what the output of their reports, I already mentioned it a little bit, where they run a geological model and have different distributions on different variables that are driving that, and their output becomes our input. Their output is typically P90, P50, P10, so the field size distribution of a given prospect, the unrisked field size distribution, and a chance of geological success. So those are the numbers that we're really looking for, that we're trying to find from these reports or from management if we don't have the reports. And then those become the inputs to our Monte-Carlo.
Just the core nav itself refers incredible range and variance.
Yeah.
So part one is, how do you know that your work or anyone else's can be ascribed to your superior outcome using Monte-Carlo for the risk or the prospective stuff versus just the variance amongst analysts, price decks and things like that. And then secondly, why not, as some people have done, put Monte-Carlo on the core nav itself?
Yeah, no, I like both questions. They're very good questions. And in answer to your first question, I would say I don't know. There's no question that it could be an outlier. It could be a fluke that we're at the, an analyst who's been an analyst for a year and a half is at the top of a group of very experienced analysts over the last year. That absolutely could be chance. Next year it could be the opposite. Who knows? So until we have more years behind us, I won't be able to answer the first question. All I can say is that the initial results look very good, and they should at least be considered and looked at carefully. In terms of your second question, that's Project 2.0. I mean, I'd like to do that. I'd like to start to break open, prove probable, possible, start to, do something along those lines. At this point, I'm just usually using 2P. I might move to 3P if the production number looks really high relative to the reserves, and there's a bit of massaging there. And I think you're absolutely right that that's kind of the natural next step for this work, is to start looking at if we could apply this to to the core portfolio. But it is a lot of work, right? So one step at a time.
Just curious what you're doing in terms of like discount rate, because obviously that's one of your values. How do you differentiate?
Of course.
Once you got all these variables that you're layering in?
Yeah, that's always the cursed question, right? Is these damn discount rates. And there's always debates about this. For me, I just use a standard 10% discount rate across the board. I don't want to get into debates all the time about what is the discount rate. And then you kind of have to use judgment. It sort of comes into that qualitative number, where we might do a qualitative adjustment. If we think you're in super high risk Nigeria in deep interior, we might say, hey, look, there's a lot of risk here that's hard to define, so we're going to bring down the qualitative number. And I like doing that because then at least it drags it out of the discount rate, and you can actually see where that discounting is happening. And if you disagree, you can get rid of it. It's transparent. But you're always going to have that problem of discount rates, and you could run a WACC analysis and start to come up with what is the proper discount rate. And sure, I mean, maybe that's another approach. But for now, I just want to keep everybody on the same playing field in terms of discount rate, so I can I know where the numbers are coming from. All right.
Thanks very much, Justin. I really appreciate the time, and certainly something a little bit different, which I think is what everybody's here for. So everybody, if we could just give Justin a round of applause. Thank you.